Hi, I'm Matt Fettig, Chief Investment Officer at the San Diego Foundation, here with your quarterly investment update for the fourth quarter of 2022. Obviously a rocky year. 2022 will go down in history as both stocks and bonds declined by double digits during the course of the year. Of course, stocks and bonds are the two primary components used to build a diversified investment portfolio. And when you have both of them down at the same time, it obviously becomes very, very difficult not to participate in the downside of those asset classes. Now, of course, as we go through the investment portfolios, I'll talk about some of the tools we have available to use in the various investment portfolios outside of those traditional stocks and bonds, and how some of those tools actually benefited the portfolios. Now, obviously, 22 was a year where we saw extreme Fed tightening. Federal Reserve raised interest rates significantly throughout the course of the year. That had a negative effect on bonds. And of course, inflation, the ultimate goal of raising interest rates was to reduce inflation. And it's been years and years since we've had inflation at these levels. That contributed to a lot of the downside you saw in the stock market. So let's begin with a review of the endowment portfolio. Remember, the endowment portfolio, close to $770 million of assets at the end of December, is really the most diversified portfolio we offer. The reason we're able to gain the most diversification here is this is long-term permanent capital to San Diego Foundation, which allows us to invest not only in liquid traditional markets, but also in asset classes that may contain different degrees of illiquidity. As I mentioned, stocks and bonds were down in double digits for the calendar year. But remember, we did have a rally in October and November, a decline in December, but the result was a gain for the 3 months, and that was really led by the rally we had in traditional equities. When you look further out, the one-year number, San Diego Foundation endowment down 7.9%, our policy index down 11%. We were able to outperform our benchmark despite results being absolutely negative for the year. The way we were able to do that was by having some of these other diversified asset classes, such as hedge funds, for example. Our hedge funds are designed specifically to mitigate volatility during volatile times for the market. And that 15.3% of the portfolio, as you see in the pie chart, was actually positive for the year. Other areas like real assets include things like commodities. Commodities obviously had a very strong period and are one of the key inflation diversifiers that we use to hedge potential inflation risk. Private equity and private credit. Despite the decline in the public markets, we did not see nearly as much of a decline in the private markets, and that certainly helped our performance. I hate to say negative performance is good on a relative basis. It was relative to our policy index for the year. But when you get out into the 3-year, 5-year, 7-year, 10-year periods, you continue to see strong performance, numbers right where they need to be to meet our spending requirement, and well ahead of the policy index. Moving on to the long-term portfolio. The long-term portfolio was structured throughout the course of the year, much like the endowment. The primary difference being that we do have liquidity constraints on this portfolio. And as a result, there are certain asset classes that did perform well during the course of 2022 that we cannot use in this portfolio. Close to 50% in stocks, another 15% in bonds. Like I said, the combination of those was a negative double-digit loss. We are fortunate that we had a big chunk of the assets in the hedge fund area, also producing a flat return for the year and also a chunk of assets in what I called real assets that have some of that commodity exposure that help to offset losses caused by rising inflation. So a strong result for the 3-month period, given the rebound we had in the markets, down 11% for the year ahead of its policy index, and you can see the longer-term numbers as well. The medium-term portfolio is a bit of a more conservative portfolio than the last we just spoke of. What's really interesting, and this is a widely observed phenomenon that we've seen across conservative investment portfolios for the year 2022, this portfolio was down 12.4% for the 1-year period. Down more than the endowment, down more than the long-term portfolio, despite the fact those two portfolios tend to be riskier portfolios. What happened? Well, we have a pretty significant chunk of this portfolio, about 65% to 70% of the assets in fixed income. This 2022 will go down as one of the worst environments for fixed income because of how rapidly interest rates rose in order to combat the inflation threat that was out there. This portfolio has about 25% in stocks, so it did feel some of the downside of the stock market as well, and only 5% in real assets, that area that did help to hedge inflation. Certainly a tougher year for what's ultimately designed to be a more conservative portfolio. Thankful to say that it wasn't just San Diego Foundation's portfolio that suffered being more conservative. It was a very common theme across the board. Next, we have our intermediate term portfolio. Remember, this portfolio is fairly new, so it does not have quite as long of a track record as some of our other portfolios. It did benefit from rates stabilizing during the course of the fourth quarter of 2022, but you can see down 8.7% for the entire year. Remember, this portfolio is 100% fixed income. The difference between this and the medium-term portfolio is, number one, it had no exposure to stocks, and number two, it has a significant position in what we call short-term fixed income, which tends not to be as interest rate sensitive. So in an environment where interest rates are increasing fairly dramatically, like 2022, this portfolio was able to protect some of that downside by simply being invested in shorter dated fixed income securities. And last, our short-term non-endowment portfolio. This is an interesting one. We've been talking about this for some time as short-term interest rates were held at zero by the Federal Reserve. This portfolio was effectively yielding nothing, zero. Remember, this is 100% invested in money market funds, and much like your savings account that you may hold, when interest rates are at zero, you're getting paid zero. Obviously, that changed throughout the course of the year, and these are quarterly results that we're showing you on this bar graph. And what you see is as the Fed raised short-term interest rates, the quarterly yield for this portfolio steadily increased throughout the course of the year. We're now at a point where yields are in the 4% range. You're getting paid to hold cash once again, but you do have an inflation rate that is above that 4%. And so on a real basis, an inflation-adjusted basis, you are losing money still by holding cash. That hopefully is a short-term phenomenon, and it is nice to see some return to normalcy where we're able to get a positive yield out of money market. So let's move on to the sustainable portfolios. Remember, both of the sustainable portfolios started about 3 years ago. They just hit their 3-year track record. They are still rather small in size, so they lack the diversification of a much larger portfolio. We have these portfolios structured with about 70% in stocks, 20% in bonds, and another 10% in real assets. These portfolios struggled throughout the course of 2022, and there are a few reasons for that. The primary reason that this portfolio struggled was that it has an ESG mandate. ESG stands for environmental, social, and governance. And we've taken the E a step further by divesting from fossil fuel producers. As inflation reared its ugly head at the beginning of this year, energy stocks tend to be an inflation hedge. Particularly in the first quarter of 2022, energy stocks dramatically outperformed the market. In fact, they were up over 30%, while almost every other sector of the S&P 500 was down to negative. By excluding energy stocks from this portfolio in an environment where inflation was the primary problem, that led to some strong negative performance. We do have 10% in real assets. We talked about real assets being a bucket where commodities could be included, but obviously in an ESG portfolio, we do not invest directly in commodities. And so some of the other real asset areas did not provide the strong inflation hedge that we had hoped. And of course, with 20% in fixed income being down about 13% for the year, it proved to be a difficult environment. Much more constructive on these portfolios going forward, and we do hope to grow them and further diversify the asset base. The next slide looks at the sustainable non-endowment portfolio, and once again, really the exact same thoughts that I just shared with you, as these portfolios essentially model each other. Any difference in investment performance is purely a function of cash flows coming in or going out. And that concludes my remarks for today on the fourth quarter update. Really appreciate you joining us today. Should you have any other questions, feel free to reach out to your donor manager or visit our website, www.sdfoundation.org, and you can find all of the investment materials on the website. Thanks.